How money actually works. The secrets of the financial system. Money is a fundamental part of our daily lives, yet very few people truly understand how it works. The financial system is complex, filled with mechanisms that control the flow of wealth, impact inflation, and influence economies worldwide. In this article, we'll break down the secrets behind money, how banks operate, the role of inflation, and how economies function in simple terms. 1. What is money? Money is a medium of exchange that allows people to trade goods and services efficiently. Before money existed, societies relied on barter systems, which made trading inconvenient. Imagine trying to trade a cow for a sack of rice. You'd need to find someone who needed a cow and had rice to spare. Money solved this problem by acting as a universal unit of value. There are 3 primary functions of money. Medium of exchange. Money is widely accepted in trade. Store of value. Money retains its value over time. Unit of account. Money provides a standard measure for pricing goods and services. Today, most money isn't physical, like cash or coins, but digital, existing only as numbers in bank accounts. 2. How do banks actually work? Banks play a crucial role in the financial system by safeguarding money, lending it out, and facilitating transactions. However, many people don't realize that banks don't just store money, they create it. Fractional reserve banking. Most banks operate on a system called fractional reserve banking. This means they are only required to keep a fraction of their deposits as cash reserves and can lend out the rest. For example, if you deposit $1,000 in a bank, they might keep $100 and lend out $900 to someone else. That $900, when deposited elsewhere, can be lent out again, creating more money in the system. This process increases the money supply, but also creates risk. If too many people withdraw their money at once, a bank run, the bank might not have enough cash on hand to fulfill the demand. 3. What is inflation and how does it affect you? Inflation is the gradual increase in the price of goods and services over time. While some inflation is normal, excessive inflation can erode the purchasing power of money, making everyday items more expensive. Causes of inflation: increased money supply. When central banks print too much money, the value of currency decreases, leading to price increases. Demand pull inflation. When demand for goods and services exceeds supply, prices go up. Cost push inflation. When the cost of production, labor, materials rises, businesses pass those costs to consumers. How inflation impacts you: savings lose value. If inflation is at 5% per year and your bank savings only earn months in interest, your money is effectively losing purchasing power. Rising cost of living. Everything from groceries to housing becomes more expensive. Debt becomes easier to repay. If you owe $10,000 on a loan, inflation decreases the real value of that debt over time, benefiting borrowers but hurting lenders. 4. How governments and central banks control money. Governments and central banks like the U.S. Federal Reserve or the European Central Bank have significant influence over money through monetary policies. Interest rates. Central banks set interest rates, which influence borrowing and spending. Lower interest rates make borrowing cheaper, encouraging spending and investment. Higher interest rates slow down borrowing, controlling inflation, but potentially reducing economic growth. Money printing and quantitative easing. In times of crisis, like the 2008 financial crisis or the COVID-19 pandemic, central banks may print money or buy assets, quantitative easing, to keep the economy stable. However, excessive money printing can lead to hyperinflation, as seen in countries like Zimbabwe and Venezuela. 5. The stock market and wealth creation. The stock market is a place where companies sell shares of ownership to raise capital. Investors buy these shares, hoping their value increases over time. Stocks represent ownership in a company and can generate returns through price appreciation and dividends. Bonds are loans investors give to governments or companies in exchange for interest payments. Mutual funds and ETFs pool investors' money to buy a diversified set of assets, reducing risk. The stock market is influenced by economic conditions, investor sentiment, and company performance. While it can be a powerful tool for wealth creation, it also comes with risks. 6. The role of debt in the economy. Debt can be a tool for growth, but also a burden if mismanaged. Types of debt. Good debt. Loans used for education, starting a business, or buying a home can generate long-term value. Bad debt. High-interest consumer debt, like credit cards, can trap people in financial struggles. Governments also accumulate debt to fund infrastructure, healthcare, and social programs. While manageable debt can stimulate economic growth, excessive debt can lead to financial crises. 7. The hidden costs of banking and finance. Many financial institutions profit through hidden fees and complex systems that most people don't understand. Bank fees. Monthly maintenance fees, overdraft charges, and ATM fees add up over time. Loan interest. Borrowers often pay much more than they realize due to compound interest. Investment fees. Many mutual funds charge high management fees that eat into long-term returns. Being financially literate helps individuals avoid unnecessary costs and make smarter money decisions. Conclusion. Understanding money empowers you. Money isn't just about earning and spending. It's about understanding how the financial system works, so you can navigate it effectively. Whether it's inflation, banking, investing, or debt, financial literacy is key to making informed decisions and securing financial freedom. By grasping these concepts, you can take control of your money, build wealth, and avoid common financial pitfalls. The financial system may seem complicated, but once you understand its mechanisms, you can use them to your advantage.